Welcome to Volatility 411 for Equity Armor Investments. I'm Joe Tigay coming to you on a VIX expiration day. The VIX expired for the month of day 2768. That is about $2 higher than it was just about 12 hours ago. The S&P 500 today is in risk-off mode, a big down day across the board, 1.8% in the S&P 500, 2% in the NASDAQ. Yesterday was a big risk-on day. Of course, we had a few days like that in a row, about a 6% rally off of the lows, and that's not uncommon in bear markets, and there's no sign of a let-up in this bear market. And I think we've had a big valuation, a recalibration, and people are talking about there's potentially more to come, especially when you factor in an economic slowdown, which I don't think the market has done quite yet. Of course, we know the Fed is trying to slow the market down, and there was a saying when the Fed was accommodative, don't fight the Fed, and the market kept on going higher. The Fed is tightening now. I think the reverse should be true. Don't fight the Fed. The market should have a big headwind as long as the Fed is tightening as much as they are. Also, we have really high oil prices, really high economic shock to the system. If you go back in time, you look at oil shocks like we've seen this year, 1973, 1991, 2001, 2008, those all were in the midst of recessions. Now, the economy is not in recession yet, but this is a big tightening effect for consumers. Choices need to be made. Now that I have to pay more money to get to work, I have to buy my gas, but I now need to choose what else I can spend with my discretionary income. And of course, we're seeing a lot of stocks, a lot of consumer discretionary stocks get hit the hardest lately. So what's this going to mean for growth? How much more do stocks need to come down? And remember, usually they get overshot on the downside. So I think there's potentially a lot more pain for valuations. For Equity Armor Investments, I'm Joe Tigay.